What are the tax implications of closing an options position? Have you ever wondered what happens tax-wise when you close an options position? It's a great question, and understanding the tax implications can help you make informed trading decisions. Let's break it down. When you close a long options position, the tax consequences depend on whether you bought the option and then sold it before it expired. The difference between the premium you paid and the premium you received when closing is recognized as a capital gain or loss. If you held the option for less than 1 year, this is typically considered a short-term capital gain and taxed at ordinary income rates. If you somehow held it for more than 1 year, which is rare for options, it may qualify as a long-term capital gain or loss. If your option expires worthless, the premium you paid becomes a capital loss, usually short-term. If you decide to exercise the option instead, the premium you paid adjusts the cost basis of the underlying stock. This means that the holding period for the stock begins at the time you exercise the option. Any future gains or losses on that stock will then be treated as capital gains or losses based on how long you hold it after exercising. Now, let's talk about closing a short options position, which is when you sell or write a call or put option. The premium you receive is immediately taxable as a short-term capital gain, no matter how long you hold that position. If you close the short option position by buying it back, the difference between the premium you received and the cost to close is treated as a short-term capital gain or loss. If the option expires worthless, the premium you received is a short-term capital gain. If the short call option is exercised, the premium you received adds to the sale proceeds of the underlying stock. This affects the gain or loss on that stock sale. The holding period of the stock will determine if the gain is short-term or long-term. If the short put option is exercised, the premium reduces the cost basis of the stock you are obligated to buy. No immediate tax is due at the time of exercise, and the holding period for the stock begins when you acquire it. For options that are settled by delivery of stock, the tax treatment depends on how long you hold that stock after exercising. Gains or losses on the stock will be capital gains or losses based on that holding period. For cash-settled options, gains or losses are realized at the time of closing and treated as capital gains or losses based on the holding period of the option itself. When it comes to writing covered calls, if the call is assigned, the sale of the underlying stock occurs. The tax treatment will depend on the holding period and whether the call was in the money or out of the money. An in-the-money call assignment can suspend the holding period of the stock, which may change what would have been a long-term gain into a short-term gain. In contrast, out-of-the-money or at-the-money covered calls generally do not affect the stock's holding period. So, closing an options position can trigger a taxable event where gains or losses are recognized as capital gains or losses or ordinary income, depending on the type of position and how long it was held. Understanding these details can help you navigate the tax landscape of options trading more effectively.